The Harami cross pattern is a potent indicator used in trading to signal a potential reversal in the market trend. It is a more significant predictor than the regular Harami due to its unique formation. This pattern occurs when a small body candle, which can be either bullish or bearish, follows a candle with a significantly larger body, highlighting a shift in market sentiment. The key characteristic that sets the Harami cross apart is the appearance of a doji, a candle with a virtually equal open and close price, instead of a small body candle in the subsequent trading session. This doji represents indecision in the market, suggesting a weakening of the prevailing trend and providing traders with an opportunity to anticipate a possible reversal. To effectively capitalize on the insights provided by the Harami cross pattern, traders should practice identifying this formation across different time frames and market conditions. By incorporating this pattern into their technical analysis toolkit, traders can enhance their ability to recognize early signs of market trend reversals. This practice not only sharpens a trader's analytical skills, but also nurtures a more comprehensive understanding of market dynamics. Moreover, the significance of continuous learning and adaptability in trading cannot be overstated. The financial markets are perennially evolving, with new patterns and technical indicators emerging as the market conditions change. Therefore, a commitment to ongoing education and the willingness to adapt trading strategies in response to new information are fundamental for sustained success in the dynamic world of trading. By staying informed and flexible, traders can navigate the complexities of the market more effectively, making well-informed decisions that align with their investment goals and risk tolerance. Candlestick patterns are essential tools in financial market analysis, providing a visual representation of market sentiment and potential price movements over short periods. They are formed by the price movements of a security or index within a specific time frame, offering insights into the market's bullish or bearish tendencies. Each pattern can signify a continuation or reversal of the current trend, making them invaluable for forecasting future price directions. One such distinctive pattern is the meeting lines, particularly significant in signaling a potential reversal in downtrend scenarios. The pattern consists of two candlesticks. On the first day of the pattern, a long black candle appears, indicating a continuation of the current downtrend. However, the next day opens at or below the previous day's low and then rises to close at or near the first day's open. This creates a scenario where the closing prices of both days meet, thus the name meeting lines. The sharp recovery on the second day to close near the first day's open suggests a shift in sentiment from bearish to potentially bullish, indicating that a reversal in the downtrend may be imminent. In essence, the meeting lines pattern highlights a battle between bears and bulls, where the initial dominance of bears is challenged by a strong comeback from bulls. This pattern provides a visual cue for traders and investors, suggesting that the downtrend may be losing momentum and a reversal could be on the horizon. As with all candlestick patterns, confirmation in subsequent trading sessions is crucial before considering it as a reliable signal for a trend reversal. The meeting lines candlestick pattern is a crucial indicator utilized in technical analysis to predict potential reversals in ongoing downtrends. This pattern is characterized by two candlesticks that occur back to back during a downtrend. The first candlestick is bearish, signifying the continuation of the downward trend. It is followed by a bullish candlestick, which opens at a new low but closes approximately at the same level as the close of the previous bearish candlestick. The almost equal closing prices of these two candlesticks form the so-called meeting lines, suggesting a possible change in market sentiment and the potential for a trend reversal. Visualizing the meeting lines in various trading scenarios, imagine observing a chart where the market is in a clear downtrend. You would see a long red candlestick indicating a strong selling day. This is followed by a day starting with pessimism, marked by a lower opening price, but ending on a positive note with a long green candlestick that closes near the close of the previous day. The presence of this pattern subtly indicates the buyers are starting to match the seller's pressure, hinting at a weakening downtrend. Though this pattern does not guarantee a reversal, it signals traders to watch for signs of increasing buying interest and potential bullish momentum. Spotting the meeting lines requires careful attention to the closing prices of consecutive days, particularly in the context of a prevailing downtrend. This pattern provides traders and analysts with a visually intuitive tool to gauge shifts in market dynamics, serving as a cue to consider adjusting their trading strategies in anticipation of a possible uptrend. Meeting lines are a technical analysis concept found in the study of candlestick charts, which are used to predict future market movements. They are particularly identified within a downtrend, signaling a potential reversal. Understanding the specific features of meeting lines, including the shape, size, color of the candles, and their positioning, is crucial for accurately interpreting these signals. In a downtrend, meeting lines are formed by two contrasting candlesticks. The first is a long black candle, which indicates a continuation of the downward trend. Following this, the market opens lower the next day, which might initially seem to suggest an extension of the downtrend. However, by the close of this second day, the price recovers to close at or around the closing price of the previous day, forming a long white candle. This recovery suggests a shift in market sentiment, indicating that buyers are beginning to outweigh sellers, which could signal the start of a reversal in trend. Key features of meeting lines include 1. Shape and size. The first black candle is long, showing a significant move down. The second candle, which is white, also has a considerable body, indicating a significant move back up to the closing level of the prior day. 2. Color. The contrasting colors of the candles are critical. The black or red in some charting software candle signifies selling pressure, while the white or green candle indicates buying pressure. 3. Positioning. The exact close of the second day in relation to the first day's close is crucial. The closer the second day's close is to the first day's close, the stronger the indication of a potential trend reversal. Understanding these features allows traders and analysts to identify meeting lines within candlestick charts. For example, in a scenario where the market has been experiencing a consistent downtrend, illustrated by a series of black candles, the appearance of a long white candle that closes at the same level as the previous day's black candle can be a vivid signal of the market sentiment changing. This specific set of candles, patterned against a backdrop of declining prices, serves as a tangible representation of meeting lines. While describing these patterns, it is important to pay attention to the context within which they appear. Market conditions, volume, and other technical indicators should also be considered to confirm the potential trend reversal signaled by meeting lines. This holistic approach to technical analysis will provide a more robust understanding of the market's direction. The meeting lines pattern is a fascinating indicator in the world of technical analysis that suggests a potential reversal in a downtrend. This pattern is formed when two consecutive candlesticks have matching closing prices but differ significantly in their opening prices. The first candlestick is bearish, continuing the existing downtrend, while the second candlestick is bullish, opening lower but closing at the same level as the bearish candlestick. This convergence of closing prices reflects a shift in market sentiment and the psychology of traders. When traders encounter the meeting lines pattern, it signifies a battle between buyers and sellers where initially sellers dominate. However, by the end of the second day, buyers manage to push the price back up to the previous close, demonstrating a growing optimism among them. This equilibrium between bearish and bullish forces suggests that the downtrend is losing momentum. The emergence of this pattern can be interpreted as an early signal that the sentiment in the market is changing. Traders recognizing this shift may start adjusting their strategies, anticipating a possible trend reversal. As more traders act on this belief, the momentum can indeed turn, leading to a change in market direction. Thus, the meeting lines pattern not only reflects a change in trader behavior, but can also prompt further shifts as market participants adjust to new expectations about the future price movements. In summary, the meeting lines pattern is a valuable tool for traders, signaling a weakening of a downtrend and a potential reversal. By understanding and acting on this pattern, traders can align their strategies with emerging market dynamics, capitalizing on shifts in momentum and trader sentiment. Meeting lines are a specific type of pattern observed in the charts used by traders and investors to analyze market trends. These patterns can indicate either a potential reversal in the current trend or a continuation of it. Whether meeting lines suggest a continuation or reversal depends largely on the context of the surrounding market conditions. In essence, meeting lines are formed when two candlesticks have the same or nearly the same closing price. This occurrence is rare but significant. When it appears in a downtrend, it suggests that the selling pressure might be easing, and the price stability at the close of these two periods signals potential for a trend reversal. However, in some cases, even in the presence of meeting lines, the trend continues in its original direction. The determining factor often lies in the details of the candlesticks and the broader market context. For example, if meeting lines are identified during a pronounced downtrend and are followed by a large bullish candlestick, it can reinforce the idea of a reversal, indicating that buyers are taking control. If, however, subsequent candlesticks show weak buying interest or continue to close lower, it suggests that the meeting lines may not significantly impact the larger downtrend, indicating a trend continuation instead. The context around meeting lines is crucial for interpretation. Support and resistance levels, volume data, and other technical indicators should be considered to gauge the potential outcome of meeting lines accurately. For instance, if meeting lines occur near a strong support level with increasing volume, it leans more towards a reversal signal. Conversely, if there is a lack of supporting factors, the pattern might just represent a pause in the prevailing trend rather than a reversal. Illustrating these principles, imagine a chart depicting a downtrend where the price action forms two consecutive candlesticks that close at almost the same level. If this is followed by a decisive upward movement, it's a vivid sign that the meeting lines may have signaled a reversal. Alternatively, if the price action remains indecisive or continues downward, those same meeting lines could be considered a moment of pause in an ongoing downtrend. Overall, it is the combination of meeting lines with other market indicators and conditions that determine their significance as reversal or continuation signals. Investors and traders should interpret these patterns within the broader market context to make informed decisions. Meeting lines in the context of technical analysis refer to a candlestick pattern that can indicate a potential reversal in a downtrend. This pattern is identified when two candlesticks have matching closing prices but opposite colors, representing a shift in market sentiment. To confirm the implications of meeting lines and assess their significance, analysts consider several factors in addition to the pattern itself. One key factor is trading volume. A significant increase in trading volume on the days the meeting lines appear, particularly on the day of the bullish candlestick, strengthens the reversal signal. It suggests a growing consensus among traders and investors about the direction of the price movement. Nearby support levels also play a crucial role in confirming the implications of meeting lines. If this pattern occurs near established support levels, it can bolster the likelihood of a successful reversal. Support levels act as a safety net, indicating a price level at which buyers are willing to step in, thereby preventing further price declines. The trend preceding the meeting lines is equally important. For the pattern to signal a potential reversal, it must follow a clear downtrend. The presence of a discernible depreciating trend before the formation of meeting lines reinforces their predictive value. The downtrend sets the stage for a possible change in market momentum, making the meeting lines a moment of potential transition. In summary, while meeting lines can signal a reversal in a downtrend, the strength and reliability of this signal are greatly influenced by trading volume, nearby support levels, and the preceding trend. These factors together provide a holistic view of market conditions, thereby allowing analysts to better gauge the potential for a change in direction. Increased trading volume, the proximity of support levels, and a clear preceding downtrend can all reinforce the significance of meeting lines. Conversely, the absence of these elements might weaken the pattern's reliability as an indicator of market reversal. The historical accuracy of meeting lines in forecasting market direction changes has shown that while this pattern can be a useful indicator of potential reversals, its reliability varies. Meeting lines are identified in candlestick charting when two consecutive candlesticks of opposite colors have the same closing price, suggesting a possible shift in market sentiment. This pattern, particularly in a downtrend, suggests that selling pressure may be diminishing, leading to a potential reversal to an uptrend. However, the effectiveness of meeting lines as a predictive tool is influenced by market conditions and the context in which the pattern occurs. Acknowledging the limitations of the pattern is crucial. Meeting lines are not a standalone indicator of market reversals. Their predictive power can be compromised in highly volatile markets or when they occur without significant preceding trends. The appearance of meeting lines suggests a moment of equilibrium between buyers and sellers, which, without further confirmation, does not guarantee a market direction change. Therefore, it is important to use meeting lines alongside other analytical tools. Combining pattern analysis with other forms of technical analysis, such as trend lines, moving averages, and volume analysis, can provide a more comprehensive view of market conditions. Incorporating fundamental analysis into this mix can also offer insights into whether underlying economic or financial factors support the technical outlook. In summary, while meeting lines can signal a potential reversal in a downtrend, their reliability in predicting market movements is not absolute. Investors are advised to use them as part of a broader analytical approach, incorporating both technical and fundamental analyses to make more informed investment decisions. Integrating meeting lines with other technical analysis tools such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, or Fibonacci retracements can significantly enhance trading decision-making by providing a multi-dimensional view of market conditions and potential reversals. Here is how they can be combined effectively. 1. Meeting lines and RSI. The Relative Strength Index is a momentum oscillator that measures the speed and change of price movements. When you identify meeting lines in a downtrend indicating a potential reversal, it is beneficial to observe the RSI for signs of divergence. For instance, if the price is making new lows but RSI starts to form higher lows, it suggests weakening downward momentum, thus strengthening the reversal signal provided by the meeting lines. 2. Meeting lines and MACD. The moving average convergence divergence is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. After spotting meeting lines, look at the MACD for a bullish crossover, where the MACD line crosses above the signal line. This occurrence alongside the meeting lines could signal that the downtrend is losing strength and a potential upward trend could start. 3. Meeting lines and Fibonacci retracements. Fibonacci retracements are used to identify levels of support and resistance using horizontal lines to indicate where possible support and resistance levels might occur. If meeting lines form near key Fibonacci levels, such as the 61, 8% or 38, 2% retracement levels, this confluence can act as a strong indication that the market may reverse from its prior downtrend, as these levels are often where retracements reverse in a strong trend. Integrating these technical analysis tools with meeting lines can greatly improve the accuracy of identifying potential reversals in the market. For example, a trader might spot meeting lines in a downward trend and confirm this potential reversal signal by observing bullish divergences on the RSI and a bullish crossover on the MACD. If these signals align near a significant Fibonacci retracement level, this provides a robust confirmation of a possible trend reversal, enabling more informed decision-making on entry and exit points in trading. This multi-tool approach allows traders to sift through noise and focus on high-probability opportunities, optimizing their trading strategy and potentially enhancing returns. In the context of technical analysis, meeting lines are indicative of a potential reversal in a downtrend. However, traders often encounter common errors and misconceptions when interpreting this pattern. One significant mistake is the premature assumption of a pattern's completion and its implications for market reversal without considering the broader market context or confirming indicators. This misinterpretation stems from a basic misunderstanding of the pattern's reliability, which varies across different market conditions. To improve pattern recognition and analytical skills, traders should consider the following tips. First, emphasize the importance of confirmation. Before acting on meeting lines, look for subsequent price action that confirms the reversal has begun, such as a bullish candlestick on the following day. Second, analyze the volume. An increase in trading volume on the days forming the meeting lines and immediately afterwards can serve as a confirmation of the pattern's strength and the potential for a trend reversal. Additionally, integrating other technical analysis tools into the evaluation process can provide more robust signals. For instance, using moving averages, relative strength index (RSI), or support and resistance levels can help validate the potential reversal signaled by meeting lines. Moreover, maintaining a broader perspective on the market is crucial. Traders should not solely rely on a single pattern, but instead consider the overall market environment, including economic indicators and news that might affect market sentiment. By avoiding these common mistakes and expanding their toolkit with additional analytical methods, traders can more effectively interpret meeting lines, enhancing their decision-making process in the financial markets. Employing meeting lines in trading involves the identification of patterns that suggest a potential reversal in the market trend, specifically in a downtrend. A meeting lines pattern is constituted by a set of two consecutive candlesticks on a chart. The first candlestick is bearish, continuing the downtrend, while the second is bullish, opening at or below the previous close but closing significantly higher, ideally at or near the previous day's open. This pattern indicates that buying pressure is starting to overcome selling pressure, suggesting a potential change in market direction. Strategies for using meeting lines to set entry and exit points include: entry point. Traders might consider entering a long position after a meeting lines pattern is confirmed, which typically occurs with a bullish candle following the pattern that closes higher than the close of the second candle in the meeting lines. This further confirms the shift in momentum from bearish to bullish. Exit point. For setting an exit point, traders might look for signs of weakening upward momentum or the formation of bearish patterns after the entry. A common approach is to set a stop loss just below the low of the bullish candle in the meeting lines pattern to minimize potential losses if the market does not move as expected. A case study that illustrates the effective use of meeting lines involves a trader analyzing the Forex market. The trader noticed a meeting lines pattern forming at a key support level on the EUR/USD currency pair after a prolonged downtrend. Recognizing the pattern, the trader decided to enter a long position at the opening of the next candle, betting on a reversal. As confirmation, the following candle closed higher, indicating increasing buying pressure. The trader set a target price based on previous resistance levels and a stop loss just below the low of the bullish candle in the meeting lines pattern. Eventually, the market rallied and the trader was able to exit at their target price, capitalizing on the reversal signaled by the meeting lines. This example demonstrates how recognizing and acting on the meeting lines pattern can provide traders with strategic entry and exit points, leveraging the potential reversal signaled by the pattern to make profitable trades. Through careful analysis and risk management, traders can incorporate meeting lines into their trading strategies to enhance decision-making and improve trading outcomes. Meeting lines is a candlestick pattern used by traders to make sense of price movements and potentially predict future trends. It is one of many tools in the realm of technical analysis that can signal shifts in market sentiment. When we talk about variations and similar patterns to meeting lines, it's like delving into a nuanced conversation about market psychology and investor behavior. These patterns, while similar, carry their own unique messages about what traders might expect to happen next in the market. One variation of meeting lines is the engulfing pattern. The bullish engulfing pattern, much like meeting lines, can indicate a potential reversal in a downtrend. However, it goes a step further. In this pattern, the second day's candle completely overlaps or engulfs the first day's candle. This suggests that buying pressure has significantly overtaken selling pressure, possibly indicating a stronger reversal signal than what meeting lines may offer. Another pattern akin to meeting lines is the piercing line. This pattern also signifies a potential bullish reversal during a downtrend, but differs in its structure. Here, the second day's candle opens at a new low and then closes above the midpoint of the previous day's candle. This suggests that buyers are beginning to gain ground against sellers, hinting at a potential shift in market momentum. For visualizing these differences, consider the meeting lines pattern as two side-by-side columns, one red and one green, ending around the same height. The engulfing pattern, in contrast, might be imagined as a large green column swallowing a smaller red one from the day before. The piercing line would visually contrast by starting even lower than the engulfing pattern's start, but not overlapping entirely, instead closing halfway up the previous red column. Each pattern's interpretation rests on how traders perceive these visual cues. A meeting lines pattern suggests a stalemate between buyers and sellers, with neither gaining sufficient ground. In contrast, the engulfing and piercing line patterns suggest that buyers are gaining control from a position of initial weakness. In practical terms, understanding these differences is crucial for traders who rely on these patterns to time their entries and exits in the market, always with an eye on risk management and potential reward opportunities.